Okay, I guess we will start. And then first, I want to welcome you all to this webinar. My name is Martin Norman. I'm an investor, engagement lead, and company strategy lead at ACCR. And today, I have with me Emilie Westholm from Folksam, Jakob Jørgensen from Sampension, and I have Alex Hillman from ACCR and Brynn O'Brien from ACCR. Some housekeeping. This webinar is recorded. The recording and the slides will be shared afterwards. For questions, please post them in the Q&A at the bottom of your screen. And in this webinar we will go through first of all a shareholder resolution co-filed by Sampension, Folksam, and ACCR, and also in more detail through Equinor's so-called Paris alignment and details around it. And with no further ado, I think I'll just hand it over to Brynn O'Brien, CEO at ACCR.
Hi, thanks, Martin, and welcome everyone. My pleasure to be talking about this co-filed resolution alongside Folksam and Sampension today. I'm going to start with a bit of background in relation to the company Equinor ASA. Equinor, as people will be aware, is majority owned by the state of Norway. In total, the state controls 71% of voting shares in the company. 67% of the shares are directly owned through the Ministry of Trade and Fisheries, Trade, Industry and Fisheries, and the ownership department of that ministry exercises the stewardship and voting powers of the ministry. Another 4% is owned by the Government Pension Fund of Norway, which is the little cousin to what we know as NBIM, the Sovereign Wealth Fund. This Equinor is a company with a controlling shareholder. That's the important piece of information. And that controlling shareholder has set expectations. I'm going to walk you through what those expectations are on the next slide. But the point to make here is that in the context of a company, a publicly listed company with a controlling shareholder, a majority shareholder, it is reasonable for minority shareholders, such as Folksam and Sampension, to seek clarification from the company's board to better understand any consistencies between the expectations of the majority shareholder and the company strategy. Alex, in the remainder of this webinar, is going to walk you through the inconsistencies that we see. We consider them to be, and our research supports the position that they are quite striking. So looking forward to getting into that detail. But the other point that I want to make before we dive into the expectations of the majority shareholder is that the shareholders do not get a vote on company directors at Equinor's AGM. The shareholders get a vote on who joins the corporate assembly and who joins the nominations committee of the company, but there is no resolution on the agenda for the AGM that goes through the individual directors. So shareholders don't get that opportunity. The corporate assembly elects the directors. Shareholders can also not directly nominate directors for election to the company. They have to put them through as suggestions to the nominations committee, and then the nominations committee makes a decision on whether to put them forward to the corporate assembly for a vote. We are aware of one instance in the last 12 months of a minority shareholder suggesting a director to the nominations committee, a highly qualified, credentialed potential candidate for the company's board, and that suggestion was knocked back. So the opportunities for minority shareholders to effectively and in a formal way engage with the company through exercise of their rights are quite limited at this particular company. That makes this request for transparency that has been put forward by minority shareholders an even more important and reasonable request. We'll move to the next slide. At the 2023 annual general meeting of the company, the majority shareholder took an unprecedented step of formally setting expectations, including that the company sets targets and implements measures to reduce greenhouse gas emissions in both the short and long term in line with the Paris Agreement. So this was done via a statement from the ministry that was read into the minutes of the AGM by the chair. So it is a formal part of the minutes of the AGM. These expectations have been directly and explicitly communicated to the company. And this particular expectation maps directly to the government white paper on the state's direct ownership of companies, which is still current government policy. There has been no change to that policy. So this is an expectation, again, of the decisive shareholder that the company sets targets and implements measures to reduce greenhouse gas emissions in both the short and long term in line with the Paris Agreement. And our analysis confirms that the strategy of the company, including the 2025 energy transition plan that's just been presented, actually takes the company further away from meeting that expectation. So we've made the following request. We'll move to the next slide. So the request is not that the company set targets to align with the Paris Agreement. To be very clear, that is not the request that the co-filing shareholders have made. The co-filing shareholders have made a request for increased transparency via a disclosure of the board's assessment of the consistency between the company's planned increase in oil and gas production, disclosed in that ETP recently, and the majority shareholder expectations, noting material inconsistencies. Its assessment of the consistency between its growth strategy in the international segment of its upstream oil and gas business and the majority shareholder expectations, noting material inconsistencies. Alex is going to walk you through why these two aspects of the company's strategy are important. And crucially, the shareholders have requested that the board disclose the remaining carbon budget assumptions that it relies on in making these assessments. We have requested that the disclosures be made by no later than the publication date for the 2025 annual report, which is, of course, early 2026. With that, I will hand over to our co-filing shareholders, perhaps starting with Jakob of Sampension, to speak to these institutions' motivations in filing this shareholder resolution.
Yes, so thank you for that, Brynn, and thank you for having us on the call. So my name is Jakob. I'm head of ESG at Sampension, which is a Danish pension fund with approximately 45 billion euros in assets. So we've been working on Equinor for some time. We were also part of the shareholder proposal that was put forward last year, fronted by Jørgensen. And we also participated in the process around putting forward a candidate for the board. And I can confirm that that didn't come through, and also that it didn't really seem that it was given much consideration, unfortunately. In terms of Equinor, Sampension's sort of position is that Equinor is doing a lot of things right, but there are certainly also areas where they can improve and where they are doing stuff that we think is colliding with global climate goals. And one of the issues is around the international unsanctioned fields, where we think that there's a sort of a pretty clear disconnect between what they're now doing and what they should be doing. So this is based on extremely long lead times on these fields. They're not very likely to come online in a decade or two. So clearly outside the scope of Paris. One of the issues here is that they have communicated maybe a bit clearer earlier that they wanted to align their business with Paris. They have also gotten a pretty clear instruction from their majority shareholder, as Brynn has just highlighted. But still, we don't see that they're sort of really putting that into their strategy in sort of a very clear way. So this is in essence what we're trying to achieve here. We're trying to sort of push this forward, this sort of notion of whether or not there is a disconnect between what they are doing and what they should be doing. And of course, we hope that a lot of investors will support this.
I'm Emilie. I am Head of Responsible Investments and Corporate Governance at Folksam. For those of you who might not know of Folksam, since Folksam is quite small in the big world, in Sweden, Folksam is one of the largest insurance and pension providers. We insure every other Swede. We have a long tradition of responsible investments. We're one of the founders of the PRI 20 years ago. We were also one of the founders of the Net Zero Asset Owner Alliance 5 years ago. So Folksam, we have committed to transition our own investment portfolios to net zero by 2050, the latest. We want to make this transition not through divestment, but through transition in the companies that we own. So with this background, it's probably clear to you all why we're interested in a company like Equinor and why it's important for us to understand their transition plan, and also if it changes, for example, with increased global focus. As a small shareholder compared to others, in particular the majority owner, we would like to see more transparency when it comes to alignment with the Paris Agreement. And this is the background. This is why we decided to co-file this resolution. And we would, of course, welcome your support.
Thank you very much for that. My name is Alex Hillman. I've been with ACCR for 3.5 years. I've got a background in engineering and finance in the oil and gas sector. I've spent almost a decade with Woodside, and I'm now ACCR's lead oil and gas analyst. So we'll take through the research we published leading up to the AGM. There's elements of it are repackaging and updates on previous analysis, but we think it supports and justifies the resolution quite well. So we'll run through all that. What we'll go through is our view on whether or not Equinor is Paris aligned, both from how we think Paris alignment should be assessed and also how Equinor presents its climate ambitions. We'll have a look at what we think Equinor should be doing to move towards Paris alignment. And then we'll have a fairly deep dive into the financial returns on Equinor's international oil and gas portfolio, specifically its over time. So as we've heard, that's where a lot of the concerns are. And then we'll have a quick look at the costs, the transition costs that climate change can impose versus the physical costs that climate change can impose. So we think that's relevant to the sort of diversified investors that are on this call and invest in Equinor. So starting with Paris alignment. So in our view, Equinor is not Paris aligned. The way we think about Paris alignment is what the Paris Agreement gives is some climate targets, and then what climate science gives is some carbon budgets consistent with those climate targets. So as you know, there's 2 climate targets within the Paris Agreement of aspiring to 1.5 degrees, but holding climate change to well below 2 degrees. So the remaining carbon budget for 1.5 degrees is about 170 billion tonnes of emissions. And the remaining carbon budget for well below 2 degrees is about 430 billion tonnes of emissions. So when we look at those remaining carbon budgets relative to the oil and gas sector, what we see is that just sanctioned projects, those projects, oil and gas projects that are operating or under construction, emit more than the entire Paris-aligned carbon budgets. And then if there's further FIDs that are made, this is just going to exceed the budgets more. So if all commercial discovered resources reach FID, then the oil and gas sector alone will consume 4 times the world's 1.5 degree remaining carbon budget. And that's before we allow for any emissions from coal, cement, or the land sector. So obviously, apportioning the whole carbon budget to the oil and gas sector is not the way the world's going to work. So it's even more dire than this, and following a trajectory consistent with the remaining carbon budget and for the Paris goals will require shutting in some existing operating oil and gas facilities. So that's our lens on how we consider Paris alignment for an oil and gas company. When we have a look at Equinor's production, so what we see is that since its IPO in 2001, Equinor's production has roughly doubled. And most of that growth, especially on a percentage scale, has come from the international segment. So there's been massive growth in the international segment, as well as solid growth within Norway. When we look at the guidance out to 2030 that Equinor recently provided, it's to grow absolute production further with a net reduction in Norwegian production and an absolute increase in international production. So from our perspective, there's no room for new developments. Equinor, with the expectations, or despite the expectations of the majority shareholder, is planning to increase and sanction new projects and increase production. So that's our view and how we think Paris alignment should be considered. We'll now turn to how Equinor presents its emissions and how Equinor presents its climate ambitions. So the first thing to note is that Equinor doesn't have climate targets. So what it has is ambitions. So this language seems designed to demonstrate a lower level of commitment than if it had a climate target. So that's just a bit of context. When we look at its climate ambitions, a credible climate metric, a credible climate target is going to, in our view, needs to cover most emissions from the company. The only metric that covers the emissions of Equinor's sold products is its net carbon intensity metric or ambitions. So the emissions from sold products, Equinor's sold products make up 94% of its footprint. So we think, like that leaves us focusing on the NCI. But even though that's the only metric that covers the majority of emissions, it's still an intensity metric. So climate change is caused by absolute emissions. It's not caused by emissions intensity. So we think to be more credible, ideally the metric would be based on absolute emissions. Equinor doesn't have an absolute Scope 3 emissions target, however. The other fairly fundamental problem with the NCI ambitions is that even in 2022, when they were first announced, the trajectory behind the NCI ambitions were too timid to align with the Paris Agreement. So that's not ACCR analysis, that's a published Equinor document where they show the trajectory of the NCI targets or ambitions along with the IEA's Paris aligned scenario. And the reduction in the NCI was slower than the reduction required to comply with the International Energy Agency scenario. Equinor likes to talk about Scope 1 emissions or Scope 1 and 2 emissions a lot, and it does manage these quite well. So the International Energy Agency actually highlights Equinor as best practice, like it defines best practice for managing Scope 1 emissions intensity. Equinor deserves recognition for that strong performance, but they're an immaterial portion of its footprint, and therefore we don't think it's a key driver of how stakeholders should be assessing its overall climate performance. So we said that in 2022, Equinor's own disclosure highlighted that its NCI ambitions were insufficiently bold to align with the Paris Agreement. In this year's Energy Transition Plan, it's softened those targets. So instead of a 20% reduction target by 2030, it's now a 15 to 20% target. And again, it's introduced a less ambitious band for its 2035 target. To test how Equinor's portfolio is trending towards those, we built a model of Equinor's NCI based off its portfolio. So what we fed into this is obviously historic data and parameters, but also future oil and gas production based off Rystad's Rystad energy data. We assume that Equinor continues to steeply reduce Scope 1 and 2 emissions out to 2035. We assume it doesn't increase gas power generation or use more offsets. And we assume, arguably generously, that it meets the upper end of both its CCS and its renewables targets. And so based off this view of the world, what we get is, those dots in 2030 and 2035 show the range of the NCI ambition, so an upper and lower range. And then the different green lines show what happens to the future NCI of Equinor's portfolio if it makes more or less allocates more or less capital to new fossil fuels. So the dark green line on the bottom is if it never makes an FID on another oil and gas project. And the top line, the lighter green, is if it continues to invest in everything that Rystad's data suggests is commercial. And so what we see is, irrespective of the decisions it makes on capital allocation to oil and gas, we don't see, based off these assumptions, how it can meet its 2030 NCI target ambition. But in 2035, it can meet its ambitions. It can even exceed its ambitions. So depending on the level of investment in new oil and gas, which, as we saw before, is principally outside of Norway, Equinor can either not meet its ambitions or it can exceed its ambitions. Equinor has, however, disclosed a plan, or a series of elements, I guess, or components, on how it says it's going to meet its 2030 and 2035 ambitions. So for a few years now, it's had a disclosure talking about its 2035 ambitions. We pointed out last year that there was nothing talking about its 2030. They included this graph in their 2024 integrated report. And to be honest, I think if this is their plan to meet their target, it raises a fair few questions, and it doesn't appear super robust. So what you can see is, of those 6 elements, the biggest driver of reduction in NCI is something called other. Like it's literally what they call it. Obviously not a terribly specific definition for the largest category of your emission reductions. When you look into the detail of their report, they include 3 things in that category. One is the increased use of oil and gas for non-energy purposes. So, if you're not burning a fossil fuel, obviously it doesn't contribute to climate change. But based off IEA data, it doesn't look like there's going to be a significant increase in the use of fossil fuels outside the energy sector. The other thing they mention is offsets. So one thing we actually really like about Equinor's suite of climate ambitions is, for its scope 1 and 2 ambition, it limits the use of offsets to 10% of the target. So we think that's appropriate. We should be prioritizing reductions before offsets. And so we would hope that they'd apply that same rationale to their NCI and scope 3 target as well. The last thing included is potential organic and inorganic opportunities. So, it's fairly vague language. It's not terribly specific. Obviously, it's potential opportunities. I presume Equinor is constantly assessing a lot of mergers and acquisitions and divestments. If it's a divestment, as we heard from one of the co-filers, divestments, we want to be prioritizing reducing emissions. We don't just want to be shifting emissions between balance sheets. So, divesting your way to a target, we don't think has a real world climate impact. And it also breaches this thing called the Greenhouse Gas Protocol, which is a de facto global carbon accounting standard. And if it purchases, potentially it's going to be purchasing renewables projects or something, which, would arguably double count. It's a bit vague about what's happening there. But we think the reliance on other calls its 2030 NCI plan into serious doubt. When we look at the 2035 plan, this waterfall they're showing, it does, most of it's renewable energy and CCS. So, in our model of Equinor's NCI, we gave Equinor the benefit of doubt of meeting the upper end of its renewables and CCS ambitions, but we still see a range of questions around this plan. So the first one, optimized oil and gas. It's not terribly clear from our reading exactly what this is referring to. My best guess is that it refers to divestments, which, as discussed previously, would breach the Greenhouse Gas Protocol if that's treated as a reduction, and it would not reduce real-world emissions. The other one, which was present on the 2030 plan, but is more significant on the 2035 plan, is decarbonised energy. So again, it's not, I didn't find a terribly specific definition of this. It appears to be referring to blue hydrogen or gas power with CCS. If it is those, then, obviously both of those rely on CCS, and the interaction between that element and its CCS target would be interesting. So, I presume they're not going to double count it, but, decarbonised energy seems to be a proxy for increasing its CCS target. So based off this view, it looks like they have a plan to meet their weakened 30% 2035 NCI target. But there's still a few questions around the clarity that we would have based on this plan. So if we have a look at our recommendations for how Equinor can become Paris aligned, or at least move towards Paris alignment. So we think there's 4 steps. The first 2 of those we think are commercially pragmatic, and that is to stop exploration for new oil and gas worldwide. We've published some research showing that the cash flow from undiscovered resources is likely to be negative until beyond 2050. So it doesn't appear terribly attractive. And then halting pre-FID fossil fuel projects outside of Norway. So the following sections will discuss the commercial face of that. But just implementing those 2 steps would avoid 81% of the future emissions, future Scope 3 emissions from Equinor's unapproved projects. So, you know, significant way towards ceasing developing new projects. The other steps, which will be less commercially attractive, but would nonetheless be required Paris alignment in our view, is we'll have to cease developing projects even within Norway, and it would have to start winding down some of its operating assets, presumably starting with those that were higher cost. So if we look back, you know, taking a step back, you know, we'll get into some financial analysis now. I think the place to start is with the whole sector. So, you know, I spent over a decade in the oil and gas sector. You know, my internal perception as a staff member working for Woodside was that that organisation and the sector just made a lot of money. My biggest realisation going from working within the sector to being an analyst of the sector is that that's actually just not true. So what we've got here is total shareholder return over a bunch of different timeframes for 3 different things. So Equinor, the MSCI World, so a measure of the world's equities market, and then MSCI World Energy, a measure of the returns from the world's oil and gas sector. And so those light blue bars, as you can see, over 1, 5, 10, and 15 years, the light blue bars are smaller than the dark blue bars. So the oil and gas sector has done worse than the global equities market. You see in 3 years, the oil and gas sector did really well. You know, that was driven by price spikes with the Ukraine war. So, but through the cycle, when you are even allowing for those price spikes and the doldrums, you know, through the cycle over the longer 10 or 15 year period, you see a fairly dramatic underperformance of the oil and gas sector versus the global equity sector. When you look at Equinor in the green bars, so over 1, 3, 5, 10, and 15 years, Equinor has underperformed the global equities market. Over the longer term, though, it has outperformed the oil and gas sector. So over 5, 10, 15 years, it's delivered higher returns than the oil and gas sector. So the sector as a whole hasn't done terribly well. But when you look at it compared to other sectors, it's not just below average, and it's not just chronically below average. It's actually the worst sector over 10 years. And the same applies to 15 years, but this graph shows 10 years. What we've got here is the green is the total shareholder return of the oil and gas sector over 10 years. And what you can see is it's right along the bottom. You can see from a bit before 2020, it started going up. So that's Ukraine war happening. And it kind of caught up to the lower performing sectors. But it's since dropped away again. What you see in black is the global average, and then up the top is tech. So, you know, what I see here is you've got tech outperforming every other sector. Then you've got 8 sectors, which are, you know, fairly well correlated. And then you've got oil and gas dropping the bottom. And it's a bit more cyclical. So, you know, it dropped away further. It recovered in Ukraine. It's dropping away again. And why is that? This is an IEA graph from 2024 or 2023, I think, showing that the oil and gas sector actually just doesn't deliver strong returns on capital employed. So over the 12-year period of this data, it delivered less than 10%. So every one of the sectors shown here delivered less than 10% through the cycle, between 6 and 9. And what we also see is that apart from pipelines, so apart from the infrastructure play, integrated upstream and refining sectors all were massively variable, so really high volatility. So what we have is low return on capital employed, low overall total shareholder returns, and high volatility. So yeah, it's just fundamentally, or historically, it just hasn't been an attractive financial proposition. When we look into the future, you know, we don't have a crystal ball. We don't model, you know, commodity forecasts or demand or anything, but we do spend a lot of time looking at the IEA. So the International Energy Agency for the last 2 years in the World Energy Outlook has said that oil and gas demand will peak in every one of their scenarios before 2030. So what you see here is oil and gas demand in steps, so a 2.4 degree climate outcome. It doesn't decline a lot, but we're entering a peak. So after decades and decades of basically constant growth, barring a few economic crises, we're going to see this structural shift where even in the highest climate outcomes or climate scenario, where we're going to see a peak, so at least a cessation of the growth. And then the APS is a 1.7 degree outcome where countries meet their targets. You see a sustained and steady terminal decline in oil and gas demand. And obviously the NZE, which is Paris aligned, you see a steeper and sharper and still sustained reduction in oil and gas demand. So financial returns of the sector haven't been great. In fact, they've been worse than every other sector. And the world is just going to get tougher for them to make those returns. So that's a step back at the sector. As we've indicated, our focus is on with Equinor is where its growth is, which is outside of Norway. When we have a look at those projects, so what this is the emissions. So on the right there, we have 6.3 billion tons of emissions. These are the emissions that Equinor's assets have emitted since its IPO. So since between 2001 and 2023, the assets, oil and gas assets Equinor has owned outside of Norway have emitted 6.3 billion tons of emissions. That's 5 times what Norway has emitted domestically in terms of climate change, in terms of greenhouse gases over the same time frame. So, as a majority owner, supporting the Paris Agreement, the influence over Equinor is much more significant than the influence that the Norwegian government has over its entire domestic economy. And then we look into the future, even with no more FIDs. So we've had 6.3 billion tons over the last 24 years. There's going to be another 13 billion tons from those assets out to 2100. So there's a huge amount of emissions coming from Equinor's overseas investments. So lots of emissions. We've also conducted financial analysis. So what we did is we built, we pulled out the cash flow data for every one of Equinor's projects outside of Norway. And what we found is that it's eroded $3.6 billion. So the NPV, so relative to the cost of capital, Equinor's shareholders are $3.6 billion worse off because Equinor has invested in oil and gas projects outside of Norway. And that's off a $100 billion investment. So there's $14 to $15 billion where Equinor has spent acquiring opportunities, so acquiring acreage, purchasing pre-FID projects, and preparing those projects for FID. And then $94 billion of CapEx post-FID. So off over $100 billion of CapEx allocation, Equinor has eroded $3.6 billion outside of Norway. So it's a pretty startling finding. I said earlier that my preconception or my perception of the industry was it generates a lot of value. So to see that it actually eroded value was startling for me personally. So we cut the data in a bunch of different ways. One kind of hypothesis we wanted to test is this just a bad apple? Is this just due to one country? Is this due to one project? Is this, is something which could be fixed, I guess, is what we were looking at, something that suggests that the future will be different to the past. So we had to look geographically. We did the same analysis on the projects based off each country. And what we found is Equinor has not delivered its cost of capital in half the countries that it is produced oil and gas in. So United States is significantly worse than the others, but half of them haven't generated value. In fact, they've eroded value. Then we had a look at projects. We had a look at every project individually. The graph there shows the ones where Equinor's share of greenfields CapEx is over $1 billion. And what you see is about 3/4 of those have eroded value. So, if the only sort of trend we can see out of this is there's no strong geographic pattern. There's no single project which is eroded most of the value. But the bigger projects seem to do worse. So, we don't have any strong thinking about why that is, but we're just seeing a broad, fairly consistent, underwhelming return on investment from these projects. So we presented this data to Equinor. So, I was lucky to hang out with Martin in Oslo for a couple of days. We went to Equinor's office. We presented this data to them, and their response was, well, they complimented the data. The research was very nice of them, but they said that they don't recognize the numbers. And it's like, well, yeah, we've QA'd the data, we've QA'd the calcs, we think they're robust, but obviously we've relied on Rystad data. Rystad build, data set that we think is great, but it is built from public disclosures. Obviously, Equinor has more detailed data at its fingers for its own projects. So what we did is we turned to Equinor's audited financial statements, and we had a look at how its Norwegian and its international segment has performed. And when we say an international segment, at times it's been disclosed as a single international oil and gas segment. At the moment, it's disclosed as a US and an international, but we've merged those where they're disclosed as two. The only input into this slide is Equinor's audited financial statements, and the only analysis that ACCR has done is to take the average over a 20-year period of a few data points within those audited financial statements. And so what we see is that the non-current assets in the oil and gas segment, in the Norwegian oil and gas segment, have been about $30 billion on average through that 20-year period. And then a remarkably similar number for the value of the non-current assets of the international segment over that period. But the Norwegian assets have generated about $20 billion of net operating income each year on average through those 20 years, which is 23 times the net operating income that has been generated by the international segment. So Equinor didn't recognize our NPV numbers. We understand we're never going to perfectly replicate their internal data. But when we have a look at this, we think it's a really compelling case that Equinor's international investments have underperformed, and they've chronically underperformed. When you look at the data series behind this applies to every year. This disparity applies to every year. It applies to every average of 5 or 10 or 20 years. It's consistent and chronic and significant underperformance outside of Norway compared to within Norway. One thing we should be clear about is we've obviously filed the resolution. Equinor's provided and published a response to it. One of the things they note is that the international assets delivered $6 billion of, I think it was, operating cash flow in 2024. So we had a look at 2024 specifically instead of an average. The Norwegian assets have still performed 6 times as well as the international assets. So there might be some, the disparity is not quite as stark as it is over the long term. But if their justification for continuing to allocate capital to this segment is that it delivers a sixth of the net operating income of its domestic operations and investments, we'd call that into question. Yeah, so we've looked at the international segment, as a whole. We've looked at it geographically. We've looked at it using audited data. We've looked at it on a project level, and we see this consistent underperformance. The last theory that we had, where Equinor could justify continued investment, was that maybe things are going to be different. Maybe they've identified some problem that we hadn't. They fixed it, and future returns are going to be great. So we had a look through previous capital market update packs. And what we've seen is that for over a decade, Equinor has been saying that it's going to get better. So in 2008, it wasn't a relative statement. Like, I wasn't saying it's going to get better, but it was going to say it's going to be really cheap. So we have $35 projects. In 2013-14, the next wave of investments will generate even greater profits. In 2015, they said they're going to radically improve their project portfolio. In 2019, they're again talking about really low break-even prices. In 2024, they're going to continue to optimize their oil and gas portfolio to invest in a profitable project portfolio. And then in 2025, they're high grading for robustness, executing projects to drive cash flow growth. So we've seen consistently in every year or two that we've, just what we've extracted, that there's been these claims that things are going to get better, the financial returns are going to be really strong. So we had a look at that. The analysis we did of projects went back to the 60s. But what we did is we had a look, and we had a look at the performance of the segment. So this isn't just the projects post-FID. This is the unsuccessful exploration and so on. Everything rolled into this analysis. And we went back to 2013 and we had a look, because that's when they started saying things were going to get better, things were going to be improved. So they've had those claims of relative improvement. Equinor made a bunch of FIDs in 2013 and 2014, which on a project basis, they eroded $3.6 billion. So we thought, well, maybe Equinor had some big projects in train. They didn't turn out very well. So let's start from 2015, where it's ignore those poor performing years. We built a cash flow model, again using Rystad data of the international segment. And what we found is that even before allowing for a cost of capital, the international segment, Equinor's international segment, has eroded $1 billion. So this includes all future cash flow. It includes all CapEx. It includes all revenue from the decisions Equinor has made to invest in oil and gas outside of Norway since 2015. And it's made investors poorer on a nominal sense. So rather than these projections of improved returns, what we're seeing is actually a regression. We've actually seen performance deteriorate further from that point. If we then look forward, so the analysis on this slide does include future cash flows, but it only looks at historic investment decisions. When we look at the future-looking portfolio, Equinor doesn't have a cost-effective growth portfolio outside of Norway. Based off Rystad data, we conclude that it's got a $40 break-even price. On average, it's international oil and gas projects at a $40 break-even price. This is more expensive than 70% of its competitors. So when you look at the global pre-FID break-even price, Equinor's average is significantly higher than that. And so when we step back and we think about this, there's been chronic multi-decade underperformance, spread geographically, spread across projects, spread across time. It's been promising to fix things. It's actually got worse, and its growth prospects are not competitive relative to the market. So we think it's time for a serious conversation around prioritizing capital returns instead of continued organic growth. So that's where our research of Equinor. We've published more than that, but that's the summary for these slides. I'll now go through a couple of slides just quickly, looking at climate change from the perspective of a diversified portfolio. One way to think about that is it's a climate change. So the oil and gas sector and other emitting sectors, they may create value. Equinor, but based on our analysis, has not done that from its international segment. But generally companies create value. But if they're creating emissions, then they're also contributing to climate change, and that has costs, and those costs are partially borne by the financial sector, and that impacts diversified portfolios. So in order to contextualize that, we had a look at data from the Network for the Greening of the Financial System, so NGFS modeling, and what we've shown here in that red line is the GDP impact of a current policies scenario. So, how much lower would the world's GDP be if we continue with current policies, which is about a 3-degree world? And so what that model concludes is that by 2100, our economy will be about 30% smaller on a GDP basis. As a rough proxy, that could translate to roughly a 30% impact on company market capitalization. But it's another way to think about it is it's only 30% over 70 years. As an annual percentage, it's not a huge number. But when you compare it to previous shocks that we've lived and we've experienced, and as investors we've worked through, if you have a look at the global financial crisis, so that created about a 4% impact of GDP over 2 years. COVID created about a 5% impact, but then a 2.5% rebound. So the impact on global GDP of a 3-degree climate change scenario is equivalent to a COVID every 5 or 6 years, but compounding indefinitely. And as we'll see on the next slide, there's a number of reasons to think that this understates the significance of the costs of physical climate change. We're doing a bit of research in this space. One of the leaders in this space is NBIM. So we've read their disclosures quite closely. They've done a whole bunch of work in this space. I think it's fair to say they're a leader in this space. And they had a look at the potential costs from an accelerated transition and compared those to the potential costs from physical climate change impacts on their portfolio. They used NGFS data, so much more granular analysis than what we've presented on the previous slide, but the same data set of NGFS models, and they also used a consultancy MSCI climate value at risk. And so what they found is that for a 3-degree scenario, the impact, and they applied this using the NGFS data to the US equities, they found there'd be a 19% reduction in NPV. So, one thing about a long-time series of GDP, like it doesn't account for discounting, doesn't account for the cost of capital. And NBIM did that. They found there's a 19% reduction in NPV from that 3-degree scenario. Even the most ambitious transition costs, the costs associated, the downside of chasing a 1.5-degree scenario was about 10%. So business as usual physical climate impacts are at least double the costs to accelerate the transition, and up to 9 times depending on the scenarios. So we're talking about the benefits of an accelerated transition are multiples of the costs of the cost of not transitioning are multiples of the potential cost of transitioning. NBIM also said that their NGFS internal modelling came up with higher physical costs than the MSCI data, but they still thought those higher values were underestimates because the NGFS models and NGFS acknowledges themselves. It's not a criticism, just an acceptance of where things are at. Those climate models, they don't incorporate tipping points yet. They don't incorporate climate impacts on natural resources, which then feed back to the financial system. And they don't look at any concurrent compounding impacts. So obviously, if you had a serious climate scenario and then you overlaid that with something like a future COVID, those impacts would compound. We see, just from a transition perspective at a bounded risk within Equinor's portfolio, we see a strong case for more concerted action. When you step back and look at the benefits to a diversified portfolio owner, we think that becomes even more compelling. But where I'll end, before I get back to Martin, is just a reminder that we're not calling for Equinor to cease investment in oil and gas. We're not calling for them to set Paris-aligned targets. We're calling for it's largely a disclosure resolution to assess their consistency with the expectations of the majority owner.
Thank you, Alex. That was, even though I have to admit I have seen this presentation, it's still quite convincing and staggering, the numbers, I have to say. But of course, and again, I wanted to, if anyone have any questions, please feel free to ask them. In the meantime, I would like to ask Brynn a question about the joker in the room, which is, of course, the Norwegian government, and any conversations or anything that you can share with our engagement with them.
Yeah, so thanks, Martin, and thank you, Alex, for that presentation and all of that extensive work. In relation, so Alex has already described our engagement with the majority shareholder on the analytical side. I just will comment briefly on our engagement with the majority shareholder on the resolution. So we have engaged with the majority shareholder on the resolution, and we will continue to engage with them in the lead up to the AGM about their position. I can't speak for them, but certainly what we have communicated to them is that we would consider it to be in the natural course of things. It would be a natural move for them to support the resolution, given that it simply seeks to reinforce the expectations that they have already set of the company and to give minority shareholders some additional insight as to the board's perception of the consistency or not of their strategy with the majority shareholder expectations. So we have indicated to them that we consider it would be a natural move for them to support the resolution. The company, of course, has recommended that shareholders vote against the resolution. So it would be a split from previous practice for the majority shareholder to vote in favour of it. But nonetheless, we think that would be the natural action for them. We would, however, be very surprised and disappointed if the majority shareholder used its position to block this request for transparency. In the context of the long-term chronic underperformance of some segments of this company's business, we do consider that the voice of minority shareholders and that the pressure that they can apply through supporting this kind of vote to be a crucially important mechanism for engaging with the board, especially in that context where you cannot vote on election of directors, you cannot nominate directors to the company's board as well. So this is the crucial moment for shareholders, minority shareholders, to register concern at the governance of the company, and in particular this deviation between company strategy and majority shareholder expectations. Thanks, Martin. I think there's a question for Alex in the chat.
Yes, there is, Alex. There is a question. If Equinor committed to increasing oil and gas production only in Norway, would we feel different about shareholder returns?
I'll probably say a couple of things to that. So firstly, I know the question about shareholder returns, but the resolution is around Paris alignment. We wouldn't feel different from a climate perspective. We wouldn't feel differently about a new project within Norway versus internationally. To more directly answer the question about shareholder returns, we haven't done a lot of analysis of the growth portfolio within Norway. Our understanding is that obviously it's performed extremely well historically. Our understanding is that the Norwegian continental shelf, the projects are getting less prospective and more challenging. So we think there'd be questions to ask, but there's probably a case that shareholder returns could be supported through investment within the NCS.
Perhaps on that, Alex, you'd like to comment on the lead times issue between the international business and the NCS?
Yeah, good prompt. I can't remember the specific numbers, but for exploration, so what we did look at, and our analysis of Equinor's portfolio from Rystad data was consistent with the International Energy Agency for the sector. You're talking, I think it was 13 to 18 years. So from the time of a discovery to the time of first cash flow, there's well over a decade to go there. So, an investment or a decision to do exploration at the moment needs to consider that you're not going to generate cash flow in today's economy. You're going to generate cash flow in 15 and 20 years' time. And as we saw from the International Energy Agency trajectories, it's going to become a more and more challenging environment to generate positive returns because demand is entering structural decline.
Thank you for that, Alex. I suppose if there are no further questions at this point, I want to thank the presenters and the participants, and also noting that we will share the recording and the slides, so you can rest assured that you don't have to understand your own notes for all the numbers that Alex has presented at this point. And if there are any further questions at any time, feel free to reach out to any of us. And with that, I will thank you all.